Come on guys, let's quickly revise accounting standard 5, which talks about net profit or loss for the period, prior period items and changes in accounting policies. You won't get marks for writing the name of the standard right, though it feels like you should be given one. The objective of the standard is that financial statements will be usually prepared based on uniformity and to ensure that you can compare the current year financial statements with the previous years. That is, uniformity and comparability are the utmost priorities for the user when he looks at financial statements. And in doing this, accounting standard 5 will classify certain items separately and ask us to disclose them so that the user, when he takes the decision, his decision is not incorrect. Now, what are we talking about? We're talking about certain items from our profit and loss statement. The scope of the standard says that we need to identify ordinary items, extraordinary items, prior period items, exceptional items, changes in accounting policies and changes in accounting estimates separately. Ordinary items will continue to be there in statement, whereas certain ordinary items which are of exceptional nature or which are prior period items, along with extraordinary items which are not ordinary, and change in policy and estimates needs separate disclosure. That, my friends, is the scope of the standard. What is excluded from accounting standard 5 is tax impact on all of these extraordinary items, exceptional items, etc. So don't have to look at accounting standard 5 for tax impact. Go to accounting standard 22. Talking about ordinary items. What are ordinary items? These are activities which are undertaken as a part of the business in the ordinary course, or for furtherance of business, continuing the business, or incidental to business. Every event and every transactions that happens as a part of the business, furtherance of business, or incidental to business is ordinary activity. By default, ordinary activities need no separate disclosure. But there are two ordinary activities or items which need separate disclosure. What are they? One is prior period item, other one is exceptional item. What is a prior period item? An item will be considered as a prior period item which appears in the current year because of an error or omission in previous year. It is omitted in the last year or recorded incorrectly in the last year. We identified that error or omission. We are rectifying it in current year. So that item which appears in current year P&L is called as prior period item. And this prior period item has to be disclosed separately. Not just prior period item, exceptional item, extraordinary item. All the three have to be disclosed separately. I'll come to this point later. For now, we know what is prior period. Prior period is an ordinary item, but it is error of previous year appearing in current year by way of rectification. So it needs separate disclosure. Then there is an item called ordinary item of special nature. We use the word exceptional item, but the word exceptional is not as per accounting standard 5. Exceptional item is the name given in schedule 3, but that represents this ordinary item of special nature, which we have inculcated as a name in this chart. What are exceptional items or ordinary items with special nature? These are ordinary items which require separate disclosure. How do we get to know? Based on size, incidence and nature, we identify their relevance for decision making. So these items, though they are ordinary, because their size is huge, because the incidence of this transaction is different, because of the nature of the transaction is different, it has to be disclosed separately. Once again, along with prior period items, exceptional items which are though ordinary need separate disclosure for its nature and amount so that we can perceive the impact of these items on P&L. Then comes extraordinary items. Extraordinary items are items which are not ordinary in nature. Usually ordinary items are part of business, furtherance of business, incidental to business. Extraordinary items are distinct from the normal operations. They are very far. They are not coinciding with your normal operations. So what are extraordinary activities? Those are events and transactions that are distinct from the ordinary activities of the business, or they are distinct from the ordinary items of the business. They are not in the normal nature of business. They are not in the normal transactions category. Earthquake, enemy attack, hurricane, thunderstorm, all of these are extraordinary items. Are you getting it? Then we go into the discussion on disclosure. Like I've been mentioning throughout, prior period items, exceptional items and extraordinary items need separate disclosure for their nature and amount to perceive the impact of these items on our P&L. Just to give example, rent, salary, purchase, everything is ordinary. Prior period item, rent of last year, not recorded last year. Purchase of last year, not recorded last year. Sale of last year, not recorded last year. Identified and rectified in current year. What about special items, exceptional items? You make the sale and earn the money, but you give huge consideration, like Dolly Chaiwala receiving 10 lakh rupees ransom from Bill Gates for sale of tea, but that money is not going to happen every year. That is special nature. Creation of provision, ordinary item. Are you getting it? Reversal of provision, exceptional item. Bad debts, ordinary item. Bad debt, forgotten to be recorded in previous year. Prior period item in the current year when you record the same. Understood? Same Dolly Chaiwala, if he receives money for being the ambassador of Microsoft, that is extraordinary item. Money received for sale of tea, ordinary but exceptional based on size, incidence, nature. Last part of the standard is accounting estimate and accounting policy. Accounting estimate is different from accounting policy. We have discussed measurement principles in framework for financial statements. In framework for financial statements, we discussed that a specific item can be measured using historical cost, realizable value, present cost or current cost. If these four methods, whatever are there, all of them fail and we cannot value an item based on the valuation principles, then we do it based on an estimate. How do you make estimate? Estimate is made based on the past experience and present situation. And there are certain situations in which this will be changed. When will we change it? We'll change it when we have more experience and we have better understanding. Then our old estimate is no more valid and then we'll replace our old estimate with new estimate. Such change is called as change in accounting estimate. Such change in estimate is not a prior period item. It's not our mistake and moreover it's not an accounting policy change also. So whenever there is change in accounting estimate, the impact on the financial statement should be prospective. You have to change it from now. And for change in accounting estimate, you have to make disclosures in your financial statements with regard to nature and amount to perceive the impact of this change in estimate in financial statements. However, due to some reason, if you are not able to identify the monetary value of such change, disclose the fact that you cannot identify the monetary value. Got it? This is change in accounting policy, estimate. This is different from change in accounting estimate. Change in accounting policy. What is change in accounting policy? Firstly, accounting policy meaning is it is significant accounting policies or principles and methods of applying those principles in preparation of financial statements. We have learned this in Introduction to Accounting Standards. We have learned this in Accounting Standard 1 also. The same word comes. What is it? Significant accounting policies and methods of applying those policies in preparation of financial statements. Now, what is the reason for change in accounting policies? Actually, accounting policies should not be changed. The fundamental accounting assumption what we read in AS1, going concern accrual ಆದ್ಮೇಲೆ ಬರುತ್ತಲ್ಲ, consistency says that accounting policy should be consistent from one period to another period. We can't change. However, there is an exception given in AS1. That is the only reason why we can change our accounting policies. What is it? The reasons can be statute, law is asking us to change. Next one, accounting standard has changed, which is requiring us to change. Number 3, there is appropriate presentation possible by the change. If you follow the old policy, it is incorrect presentation. If you switch to new policy, new policy is giving you better presentation or appropriate, then what should you do? You have to change. That is the reason for change. Unlike change in estimate, when you change estimate, what do you give? Prospective effect. When you change accounting policy, we should give retrospective effect. We should change it from the beginning. In fact, when we discussed accounting standard 25, if you remember, if there is change in accounting policy in quarter 3, you have to redraft your interim financial reports for quarter 1 and quarter 2 also. We've discussed that. Lastly, whenever there is change in the accounting policy, check about its materiality. If in case it is material, disclose the change in accounting policy, reason for such change in accounting policy, financial impact if any arising because of such change in the financial statement, because that will have an impact on the financial statements, and to perceive the impact of such item on the financial statements for the user's decision making, it has to be disclosed separately. Got it? Good.